In 1972, Wall Street crowned a group of one-decision stocks. Buy once, hold forever, no thoughts, no stress, just vibes. Then reality showed up like a substitute teacher with a clipboard. Today, the Magnificent Seven run the cafeteria again. As of February 2, 2026, they sit at about 34.3% of the entire S&P 500. That is not a nice little slice. That is the whole pizza deciding it is also the box. This video is simple. I'm going to show you why betting your whole future on the popular kids looks smart right up until gravity remembers your address. And yes, gravity still works, even on tech. Now it's time to go off school and count the chairs at the cool table. So who is sitting at the cool table? Apple, Microsoft, Nvidia, Alphabet, Amazon, Meta, Tesla. If you own an index fund, you probably think you own the whole market. You do, but you also own a very large chunk of the same 7 kids wearing the same jacket, sitting at the same table, soaking up that shared confidence. Is that automatically bad? No. Is it automatically safe? Also no, because concentration is not the villain. Price is the villain. Price wears a mask and calls itself certainty. Now, time travel with me to 1972. Back then, investors fell in love with the Nifty 50, roughly 50 big-name companies that institutions treated like sacred objects. IBM, Xerox, Polaroid, Coca-Cola, McDonald's, Disney, Avon, and more. They got called one-decision stocks, meaning buy once, never sell, retire early, become a beach person. Sounds familiar, right? People still talk like that. They just replaced one decision with just buy the dip. Here's the first big receipt. At their peak, in late 1972, the Nifty 50 traded around 42 times earnings, while the overall S&P 500 traded around 19 times earnings. Translation: investors paid more than double because they believed the story more than they respected the price. And stories are powerful. Stories get you to ignore the bill. Why would anyone sell Xerox, the company that basically owned the office? Why would anyone sell Polaroid, the company that made pictures appear like magic? Wait, what could go wrong? Plenty. Because when you pay luxury prices, you need luxury perfection every day. No bad quarters, no slowdowns, no surprises, no competition doing anything rude. Then, the easy era ended. Inflation climbed, rates moved, the economy got cranky, and the market stopped rewarding popular. It started punishing overpriced. Here's another hard receipt. The S&P 500 fell about 14% in 1973, then about 26% in 1974. The Nifty 50 did worse, down about 19% in 1973, then down about 38% in 1974. That is not a dip. That is a trap door. And inside the trap door, the invincible names got cooked. From their 1972 to 1973 highs down to 1974 lows, Xerox fell 71%, Avon fell 86%, Polaroid fell 91%. Read that again. These were not random meme stocks. These were the best companies in America, and they still dropped like they owed gravity money. So what killed them? Not always the business, the price. A great company can be a terrible investment if you pay a luxury price for real-world profits. Now, back to the present table in the cafeteria. The Magnificent Seven are real businesses. They sell products people actually pay for. They print cash. They also carry a lot of the index on their shoulders, and the market has been treating them like the only kids who matter. Is that because they're amazing? Partly. Is it also because everyone is afraid to miss out? Also partly. People don't just buy stocks, they buy social proof. Now, let's talk about Nvidia, because Nvidia is the kid everyone is copying homework from. As of February 6, 2026, Nvidia trades around the mid-40s on price to earnings, roughly 45 to 46 times earnings, depending on the source and method. That is not a little expensive. That is pre-ordering hope. When you pay 46 times earnings, you're paying today for a long line of perfect tomorrows. You're saying, I believe the next years go exactly right, and nothing ever gets weird. And the universe loves weird. To be clear, Nvidia is not fake. This is not some empty hype balloon. AI chips are real. Demand is real. The risk is simpler. The price leaves no room for normal life. Ask yourself this: what happens if growth slows even a little? What happens if a competitor shows up with a better deal? What happens if big customers pause spending for 2 quarters? When a stock is priced for perfection, the smallest imperfection gets billed like a crime. Quick detour. Imagine a movie ticket costs $46 because the trailer looked amazing. Then you sit down and the movie is just good. You don't clap, you ask for a refund. That's what repricing looks like. And the market has another giant receipt sitting on the table: spending. Alphabet, Amazon, Meta, and Microsoft are forecasting roughly $650 to $700 billion of capital spending in 2026, largely tied to AI infrastructure, data centers, chips, and compute. Call it roughly $700 billion. That is not a budget. That is a weather system. This matters because spending is not profit. Spending is a bet, and bets can win. Bets can also become very expensive decorations. So the question is not, is AI real? AI is real. The question is, does AI pay back fast enough to justify today's prices? Because those prices already assume a beautiful ending. And when everyone assumes the same beautiful ending, the market starts acting like a high school yearbook committee. No one votes for "it might be complicated." Quick glove touch to the algorithm. Tap like, then get back in the ring. Now, let's connect the dots. In 1972, investors treated the Nifty 50 like forever stocks. They paid around 42 times earnings for safety and growth. Then a rough economy hit. Rates moved, inflation bit, and the same forever stocks dropped 60 to 90%. Today, investors treat the Magnificent Seven like the only safe place to be. They paid big multiples for the belief that these companies can't lose. But the market doesn't punish companies for being bad. It punishes prices for being silly. So what are the possible paths from here? Path 1. The Magnificent Seven execute perfectly. AI demand keeps rising, margins hold, competition stays polite, stocks keep climbing. This can happen, but perfection is not a strategy. It's a prayer with a spreadsheet. Path 2. They execute well, but not perfect. AI grows, but slower. Costs bite a little. Competition nibbles. Stocks go sideways while earnings catch up to the price. This is the nothing breaks, but nothing pops outcome. It feels boring. Boring is underrated. Path 3. Something breaks. A recession, a policy shock, a tech shift, a demand pause, a single ugly earnings season. And because the index is so top-heavy, the stumble turns into a slide. Not because the world ends, because the price stops pretending. This is the part people hate, so I'll say it clean. You don't need all 7 to fail. You just need 1 or 2 to disappoint while priced like superheroes. That's how the Nifty 50 got humbled. Not by becoming trash companies, by becoming normal companies stuck in abnormal prices. So what do people try next? Some investors tilt toward equal weight funds, where each company gets the same weight instead of letting the biggest names dominate. That's not flashy, that's the point. Some investors look outside the US because a lot of international markets trade at lower valuations and lower concentration. It's not a thrill ride, it's a seatbelt. Some people simply rebalance, not because they hate the popular kids, but because they don't want to bet their whole future on one lunch table. Now, the clean takeaway. The Magnificent Seven can stay magnificent. They can also stay great companies while becoming mediocre stocks if the price stays too high. 1972 didn't teach never buy great companies. It taught don't overpay and call it safety. Always check the receipt before you buy the story, because gravity is patient and it always collects. Give the subscribe button a gentle suplex, then go look at what you actually own and what you actually paid for it.